doesn't work unless the borrower can refi at a higher amount. Is that right, Bob?
That is right, but there's no evident problem with doing that.
For every one of these underwater loans?
Well, I mean, you could never say that, right? Never say never and never say always, right? But the idea is, yeah, if you're choosing the loans well, right, carefully, and you're choosing only loans whose expected values can be increased by lowering the principal, then again, I mean, almost by definition, you're choosing the loans that are going to be sort of refinanceable.
But to a lot of people, it
Except
sounds
for the
like cherry picking only the best credits,
Two responses to that.
which doesn't. I mean, does that? The question ultimately is, does that fulfill the public policy objective?
Yeah, well, again, there's sort of two responses to that. One is, if indeed there is cherry picking going on, the question is, are you paying the price of cherries, right, rather than the price of lemons? In other words, the fair value is higher in the case of cherry, and so, of course, that much more has to be paid. That's the first point. Second point is, again, the difference between cherries and lemons, or cherries and oranges, and so forth, is really not the critical difference, right? That is the critical distinction to draw here. The point is, again, at least as I look at a proposal of this kind and as I evaluate it or advocate it, the critical question is this a loan whose expected value can be raised by writing down principal, right? And then is there some explanation for why this loan, whose expected value can be raised by writing down principal, has not already been, right, modified? And typically, the answer is going to be yes, there is a reason. And typically, that reason is going to sound in market failure, right? Classic, orthodox economic theoretic market failure, whether it be in the form of a contract rigidity or a collective action problem or what have you. And choosing the loans carefully is essentially choosing them by reference to those kinds of failures. Because again, those kinds of failures are those that by definition, you are adding value by rectifying. That's the whole point.
Laurie?
Let me add a couple of things. First, you are correct that many of these loans can be helped by being modified. In fact, a lot of them have been modified. About half of the loans that you're looking at that would qualify for this program are current and underwater, and they're current because they've already been modified, which has made them current, so they've had a successful modification. And so it's not clear that further action enhances value anymore. And in fact, I would argue that in many cases it does not. Secondly, the question is, what is value? And I think this is really, really critical. The reason private label trusts are being targeted for this is because there is nobody in charge of safeguarding the value. Julia is quite right. These the trust documents are defective. And therefore, the trustee doesn't have any obligation to challenge the value. And in fact, you can argue that it would be non-economic for them to do so because we actually looked at the loans affected by San Bernardino, and no single trust has more than 12 of those loans. So it would be non-economic for any single trustee to challenge the value of any single trust. And the servicer also has no obligation to challenge the value. When they get the money, they just distribute it according to the waterfall, and that is the end of their obligation. So these trusts are essentially being targeted because of the way the PSAs are written. They are a very, very easy target that this program is taking advantage of. Julie made the point about bankruptcy being very powerful, and it was chosen not to be used. Yeah. Most of us investors like the idea of bankruptcy as well because it actually allows the borrower to stay in their home by resizing all of their debt and not just their first mortgage debt. That was a very, very powerful tool, and it's a shame that more credence wasn't given to it early on. In terms of the cherry picking, I think that's a very real issue. The takeout for these loans, as the MRP program, as Robert mentioned, is the FHA short refi program. That requires these loans to be current. There's going to be some period of time during which you go through the process. So you have to do the FHA short refi application and all that. So basically what that requires is cherry-picking loans that have been current for a fairly large number of months to make sure they're going to be current at the time of the sale. So you are doing cherry picking, and as Robert mentioned, you pay more for loans that have been cherry picked. Well, that's not what's being done here. What's being proposed is 80 to 85% of the value of the property. The value of the property is very, very, very different than the value of a loan that is current and performing. So basically, figure out what the value of the loan that is current and performing is. It's the value of the loan if it continues to perform, times the probability it continues to perform, plus the probability of the loan if it's liquidated, times the probability that it gets liquidated. Even for deeply underwater loans, the probability of default is on the order of, say, 40%. So you're paying way, way too little if you're paying 80 to 85% of the value of the underlying property.
I know you guys from SIPA wanted to address that point. Did Laurie sum it up well enough, or did you want to add to it?
No, something must be added.
Go ahead.
What must be added is that absolutely everything I've seen about the eminent domain concept that claims to provide just compensation as is required constitutionally fails. It fails because of a misunderstanding of what it is that the investor from whom the mortgages are taken is entitled to under law. The investor is entitled to be made whole economically as though the transaction had never happened. And let's take a look very quickly at what that means. It is far, far more than the value of the whole mortgage which has been extracted from a mortgage-backed securities pool. That may seem very, very abstract or technical, but that loan comes out of the pool. The loan is worth less out of the pool than it is in the pool. We then have the residual pool, that is the rest of the stuff that's left with the investor that the cherry picker didn't want. That pool is worth less, far less than it was before the cherry picking took place. We have all this fruit salad going on here. Before this taking took place, because the second best tranche of the pool has been removed. That is to say, those that are current, or I guess we can give some credence to the fact that there are other programs. But these loans have diminished the pool that the investor holds, and that must be valued and compensated for. Also, a prudent investor will always ask the question, how are we going to buy this? We're going to buy $500 million in mortgage-backed securities? How? We're going to go to market. If we're a bank, are we going to use deposits? How are we going to pay for it? What happens? Interest rate risk. You take the asset away, the funds, the liability is there, but it's attached to nothing. It's a pure expense. Bank regulators would never allow that. So we have the issue of how to dispense with, how to manage the funding. And lastly, in many cases, there will be what you would call a basis risk or a differential between the behavior of the funds and the behavior of the asset, and that would require some hedge program. And that hedge is absolutely useless. Once you change the asset, you've got to negotiate to sell it back, and that may be the most expensive part of all. So there is a multi-point program of expenses here that are necessary to prevent the original investor from being absolutely scalped and failing on its contractual and moral and legal obligations to the millions and millions of working American people who are entrusting their hard-earned savings with these funds managers to buy assets to make them grow for savings and retirement purposes. So it's a complexity, please. It's not a fruit salad.
Yes, Bob.
Yeah, just a couple of quick points. The thing to remember, the two things to remember at the outset, right? The first is that there's only one plan out there that was originally talking about targeting only performing loans, and even that plan is no longer talking about targeting only performing loans, right? So that means all programs that are out there in circulation now are talking about not cherry picking, but looking at all loans whose EVs can be raised by writing down principal. First point. Second point is to remember, even if there were cherry picking going on, any delinquent loan or any defaulted loan was at some point a performing loan, right? And as it happens, in the time since the announcement has been made about the MRP program in early June, hundreds of then performing loans have since gone delinquent or into default. If you want some idea as to what the rates of default are on underwater loans, just take a look at the 2011 10K form filed by Fannie Mae, right? So according to Fannie Mae's 2011 10K, I think that's on page F55 thereof, subprime loans in their portfolio are expected to default at the rate of 73%. Option arms are expected to default at the rate of 69%. Fixed rates, even fixed rates, are expected to default at the rate of 40%. And variable rates are expected to default at the rate of 59%. Those are their 2006 vintage loans. Now, as you can imagine, in San Bernardino in particular, which is we've been talking about as ground zero, the subprime loans represent a huge portion of those underwater loans. And indeed, there's a sort of a subtext here that we haven't gotten to yet today, and that is, of course, the ethnic story, right? So as you know, San Bernardino County is something like 40% Hispanic, around 10% African American, around 10% other non-Anglo. And of course, as we know, those sectors of our population have overwhelmingly, disproportionately been targeted by subprime lenders and other non-prime lenders. And it's their loans that are most at risk of default, and therefore, no surprise, it's their loans that have been defaulting and that are way underwater across the board. I think it's around 50% of the mortgage loans in San Bernardino County that are underwater. And again, if the average LTV in San Bernardino County is somewhere around 170%, which is astronomical. So these are places where even currently performing loans are performing because